Hello everybody, I'm Jeppe Kirk Bonde, one of the most copied popular investors on eToro, and welcome to this 2025 Q3 quarterly investor update. If you want to use this presentation for anything, please go ahead and read the disclaimer down here very carefully. So in this presentation, I'm going to talk about my background, my investment strategy, what I currently have in the portfolio, and finally go through the many questions that I've received in advance. So firstly, one of the reasons that more than 28,000 people are copying my portfolio on eToro is that I've really beat the benchmarks since I started in 2013 with quite a significant amount. Since 2013, I've had an average annual return of investments of 25%, which is really better than any benchmark or other top investor you could compare with fairly. So also with a better return to risk profile than many others you could fairly compare with. Terry Smith, for instance, he started his fund around the same time that I started on eToro. So those are very much sort of like for like comparisons in terms of time frame as well. My background is from strategy consulting, advising some of the largest companies in the world, including banks, tech companies, and aerospace and defense companies. And then I've been investing on eToro since 2013. Back then, I was, as a consultant, making more money than I was spending. And so I wanted to invest some of my money. And then I compared all the different platforms to see which one was better for me. I compared them in terms of the website, the app, fees, how good the platform's developing over time, risk, and so forth. And then eToro came out as number one. And so I started investing on eToro. And then because my investments were doing well, people started copying me, including friends and family, and then many others. And then in 2018, I was making more money from my eToro investments than my consulting job. So I quit my consulting job to focus only on managing my money on eToro. And then I hired a small team, and it just continued from there on, basically, to get bigger and bigger. Now, I don't do everything on my own. I have my great assistant and a good network of experts that I trust on complex topics. So if I invest in anything, then I must either myself be an expert or they must be. Otherwise, I can't get to the right facts quick enough. Then I get very strong support from eToro. So whenever I have any questions or concerns, there's always someone from eToro who's quick to help me out. Then I subscribe to the best data providers and have access to the best IT tools so that anything that should be automated is automated. And finally, I'll highlight my three favorite experts, which are my three brothers. So one of them, he studied computer science and works with AI. One of them, he is an economist with the Danish Ministry of Finance, and one is the CEO of a marketing company. So if I have any questions or concerns within those areas, then they are my go-to guys. Then my investment strategy is based on some principles that have been there all along and continue to be here. I focus on macroeconomics, seeing how different pockets of the global economy can grow over time. I focus on megatrends. So these are trends that can grow by more than 10% for potentially more than 10 years. Then I focus on fundamentals, analyzing companies really carefully in detail, understanding their financial statements, their products, their services, the technology level, the different strategic opportunities, and what it's like to be an employee there, what it's like to be the customer, what are their suppliers like, and the suppliers, and all of that with a view of getting to a valuation of the company. What do I really think that company is worth? I then compare that to the company's price and invest in companies that I evaluate are worth a lot more than their price would indicate. And there's a great quote by Warren Buffett. He said that price is what you pay, value is what you get. And I really subscribe to that. Then I focus on the long term. There's a great quote by Benjamin Graham, the author of the book, The Intelligent Investor. And he was sort of Warren Buffett's mentor. And he said that in the short term, the market is a voting machine. In the long term, a weighing machine. And that really means that, yes, in the short term, it can be important what other people think. But in the long term, if a company becomes very big and profitable, it'll probably be very good to own a big part of that business. And if you can do that earlier, then that's a good thing. And I have the patience to wait around for the weighing of the companies, not just for the voting. Then I focus on risk management, diversifying across many different industries, geographies, and business models. Focus on hedging. So that means finding different risks that when put together cancel each other out. When people are born, they, for instance, don't have a house. And then you need a house in your life. So then when you buy a first house, you're actually hedging your need for a house by buying a house. So many people, when they buy their first house, they start caring a lot about the property prices because like, ooh, what happens to the price of my property? But actually that's the time when you can stop caring, because if property prices suddenly double, well, your house is worth twice as much. That's great. But also the cost of you fulfilling your need for housing is twice as great. So you haven't really actually gained or lost anything in that term. However, if you don't own a house and the price doubles, well, then that's very bad. And if you own too many houses compared to what you need and they fall a lot, well, then that's bad as well. But you can find a level. Another example of hedging is if you have, for instance, a company that produces energy and one that consumes a lot of energy. If they are one selling to the other and the price of energy goes up a lot, well, one of them certainly loses out and the other one gains. And if the opposite happens, well, you still have one that lost and one that gained. And so you neutralize that effect. That's hedging. Then finally, I conduct stress tests, seeing how my portfolio and different variants of it can perform in different extreme scenarios, incurring bad and very bad ones, and then trying to make adjustments so that they could potentially perform better in those extreme scenarios. Then finally, I focus on keeping the fees low. I don't use any leverage, don't do any high fee instruments, and don't do any day trading. So buying and selling and buying and selling and buying and selling is just a way to pay a lot of fees. It's better to buy the right thing and hold it for a reasonable period of time in general on average. Then there are some areas where I see great opportunities. I like companies that have organic growth. That means they can be selling more products or increasing the price of their products by more than the prevailing inflation rate. But it doesn't include companies that are just growing through acquisitions. So sometimes you can read at the beginning of the annual report that, oh, we grew revenue by 4% this year. Actually, that's just because they acquired other companies. The core business shrank by 2%, so it's not really that impressive what they've achieved. And if a company, on the other hand, they acquire some companies, and after the acquisition, then they manage to grow them a lot, then that still counts as organic revenue, and I do like that. Then there are companies that I like because they're very resilient. Having a high level of resiliency is something I like seeing across any companies. That means having strong, sustainable competitive advantages or a clear route to get them, having a strong balance sheet, and being potentially able to protect my portfolio if something extreme were to happen in the negative direction. Then I like companies that are profitable, truly profitable, creating real value, and ideally able to reinvest that value into themselves to grow further over time. Then I like companies that have a new company strategy. It's not enough to me that they announce that they have a new strategy. I have to see some concrete steps that prove to me that there is really a new strategy and it's really going to happen. So, changing the company's name or changing the CEO or selling off a part of the company. Those are some of the things that could tell me like, okay, they're really serious about this. It's not just a, empty piece of paper. Then I like companies with great products and great services. Quite often the best product wins out in the long term. A classic example of failing at that was when Steve Ballmer, the former CEO of Microsoft, he held the first iPhone in his hand and was laughing at that. It didn't have a keyboard. It was too expensive. Business users wouldn't want to use it. And he was, of course, proven wrong by the massive success of the iPhone. And that was an example of holding the blockbuster product in your hand and just not being able to see that this is the blockbuster product. And many people have recently been doing this very same mistake with Nvidia, with Palantir, with Tesla, and so forth. Just looking at the blockbuster product and just not being able to identify it as so. If you are a smart shopper, you're good at comparing products and services, understanding why it's worth to pay more for this one and not for that one, why you need this feature, not that one. You buy something and you're happy with what you bought, then sort of if you can understand products and services, then you have a chance of understanding companies as well. If you don't understand products and services, then you have no chance basically of understanding the companies, and then it's much harder to be a good investor. Finally, I like companies that are mission driven, not just because I sometimes believe in the mission, but because it can be a great way to attract great people without overpaying them. There are some companies that are absolute magnets for talent, the smartest, most hardworking people that just really want to go there, and there are others where even if they get overpaid, they still can't get the best people. And if some of the greatest people, they get into that organization, within a couple of years, they will have left again. And whether a company is one end or the other of that spectrum can really show itself in the financial statements a few years down the line. Then if we look at my portfolio, it's almost entirely invested in stocks. And that makes good sense because historically, stocks have been the best asset class. I also have some investments in property in the portfolio, and that also makes good sense. Property has historically been very good as well. Not as good as stocks, but pretty good. Bonds have historically been okay. Think now they're not as great. If you look at the interest rate you generally get across many different bonds compared to the inflation rate. Commodities have historically not really done much. If you had a gold bar during the Roman Empire, then that gold bar would have remained a gold bar, and today you would just still have one gold bar. So it's really not that incredible. I think potentially they'll do a little bit better in the future, and they have done better in recent decades, but ultimately a company can grow and grow and grow. Commodity more or less stays the same. Then there are collectibles. Many people have a deep passion for these ones, but ultimately they have not historically been the best category of investments. Individual ones have for different periods of times, like the right art at the right time, Birkin bags at the right time, Pokemon cards, so forth. But there have been many others than, stamp collections that have then lost a lot of value. And when you add those up, then you end up with a not so great result. Finally, currencies have historically been terrible. I think they're currently terrible and probably will continue to be terrible. Ultimately, currencies, they kept being made more of them from the central banks, and so the supply just keeps increasing. There's always constant inflation, basically, and so you're just losing out to that by holding a lot of currency. And so, yeah, whenever I have too much of that, I like to get them transitioned to the left in this chart and ideally into some stocks. Then we have a new asset class. All of these ones are more than several hundred years old as asset classes, but crypto is a new young one, and you can probably say that crypto fits in, depending on the crypto, into one of these other categories a little bit. So you have some that are more like collectibles, you have some that actually function kind of like currencies, you have some that could be treated more like commodities, and some where you are really potentially, with your crypto investment, investing in a technology company, and that's really what's driving it. You want the developers in there, you want them to be able to do something from the blockchain, and then it's actually more akin to a stock. So depending on which one it is, it can have some of these characteristics where we have much older track records to rely on for sort of guesstimating potential future returns as well. Then there are some big factors that drive the global economy in the long run. So I like to split them up into the physical, the social, and the technological realm. In the physical realm, I look at nature, how many trees are in different places, how much oil is in the ground, how much of different metals can you mine there, and so forth. Then I look at life, not just animals, but chiefly humans. The companies that have the right products for the right demographics in the right places, they have an advantage. And yeah, so I look at how demographics are changing over time in different places in the world. Then the area in which the most value can be created or destroyed the fastest is in the social realm. So if we have a bond or a stock or a deed to a property, these are all just pieces of paper or numbers on screens and thoughts in people's head. If we believe those have value, then they can help us transact with one another, cooperate with one another, and it's that cooperation that unlocks so much value creation. And if we stop believing in those things, then that value creation can grind to a halt and a lot of value be lost very quickly. Then there, why does anything have value? If we have a house, it's very easy for people to grasp why that house has value. I mean, it's very concrete. It's made of brick and mortar or concrete, and so obviously it has value. But hypothetically, if nobody wanted to live in houses and nobody wanted to look at houses, then houses wouldn't have any value. Sometimes what we humans value changes over time. And then when that happens, if you can get in early on that, it can be the basis for great investment. Then finally, there's the technological realm. So all the way from the deepest pits to the R&D labs to the final stages where people are changing the way they're using products out in their own homes. The most important of these are the big foundational technological shifts. So going from the agricultural revolution to the industrial revolution, getting the internal combustion engine, then the electrical era, the digital era, and now potentially we are starting to see the early stages of the AI era. And AI is probably the next technological foundational shift that we humans are going through. And yeah, that really is one of the biggest drivers of growth long term. But from those long-term growth drivers, we can then zoom in on how the world economy is doing today. So today we see that GDP growth is generally quite okay around the world, a little bit sluggish in the EU, but otherwise generally okay. Certainly not bad. Unemployment rates are lower than they were before COVID, so that's also quite nice. Now there are concerns that they could be becoming higher over the next year, that some negative events we've had haven't shown the effect on unemployment very quickly, but that maybe it will slowly come unless central banks react, which they're most likely to do. Interest rates are at a quite reasonable level, quite low in the EU, but otherwise at a quite sensible, good, stable level, which gives central banks freedom to really react to anything they see out there. When you are at a good level, it means you have the opportunity to lower the rates if you need to. It means you could potentially even keep them steady if you need to. You're at a good balanced level. When you have inflation rates globally, they are quite above target, but they are sort of have been coming down, although they went up a little bit recently. But ultimately, there is a general consensus that more unemployment later is slightly more risky than inflation not coming down as quickly as we would want it to. And so that's leading most people to expect central banks to be reducing interest rates in general, and especially the American one. But ultimately, it's sort of, we are quite close to target on inflation. We are quite close to target on unemployment, quite close to target on growth, and interest rates are at a quite reasonable level. So it's a nice time to be investing from a macroeconomic perspective. And in terms of, there was a time during COVID when central banks were really out of firepower. So we had a crisis, but we sort of did everything we could to solve the crisis. But that also meant that if there was a second crisis, suddenly we would have nothing left to really fight with. Now central banks are really well polished again. They have room to maneuver. So if there is some sudden shock of some kind, they can just react and do an expansionary monetary policy and really support the economy at such a state. And that's makes it a comfortable time to be investing, really. Then there are some mega trends that are found to be extra interesting. So if a company is driving or riding on the wave of one or more of these mega trends, then it's more likely to be found in my portfolio. So firstly, I like the nice to haves. When we humans, we have it all, then we like to compete in who can have the better fashion and who can win at fun games. And there are some great companies with good profitability, good growth potentials in these industries that are to be found in the portfolio. But the nice to haves cannot really stand on their own, neither just in the world nor in a portfolio. They stand on the shoulders of the need to haves. If we don't have any energy and we don't have any security, then we can't decide for ourselves and we can't have all these other nice things. And so the portfolios that are key to delivering energy and security, they are also to be found in the portfolio. Finally, there are the enablers and accelerators, the things that help us do these other things faster, better, cheaper. And chief of these, AI, the companies that potentially will make the most profits from the AI revolution are to be found in the portfolio, along with the companies that are creating the next generation of amazing devices for us in the future. Then, if we want to look at an industry and get a quick overview of how the different companies stack up against each other, a great way is to look at the multiples. So this is an example from the Magnificent Seven: Microsoft, Apple, Meta, Tesla, Nvidia, Alphabet, and Amazon. So if we look in the top left corner, we can see the profit margin. So here we can see that Microsoft's doing very fine at 46%, Nvidia all the way to 58%, but Tesla are lagging quite a bit behind with only 6%. In terms of growth rate, we can see that Nvidia is doing incredibly well at 86%. Meta is doing well at 19%, but Tesla is actually declining. That's not very good. These two top charts, the higher the better, because they're about profitability and growth. But these two bottom charts, the lower the better, because they're really about price. So at the bottom left corner, we can see that for every dollar of profit that Microsoft brings in, as investors in aggregate, we have to invest $29 to have a right to that $1 of profit. And for Meta, it's only 24, for Alphabet, only 19, but for Tesla, it's 182. So that's a lot higher. We'd only want to pay that much more for Tesla if we believe that they can massively improve that profit margin in the future, or get back to some growth again, stop declining and actually have serious growth. We didn't believe that, then we wouldn't want to be paying that much more for Tesla. And similarly, if we look at the bottom right corner, we can see that for every dollar of revenue, we as investors have to invest $13 to get the rights to that revenue. For Microsoft, very fine. For Amazon, it's only $4, but for $4 of enterprise value for every dollar of revenue, and that's obviously a lot cheaper, but they're also getting a lot less profit out of every dollar of revenue, and they're also not growing as much. For Nvidia, we're paying $29 for every dollar of revenue. but they're also growing a lot, and they're also getting a lot of profit out of every dollar of revenue. So that's sort of a way to get a quick overview of some companies using the multiples. Then the work that I do every day is discounted cash flow analysis. I start by getting data that automatically comes into all of my models from different data providers, and then there's data that I complement with my subjective insights. So that can be something like, how much do I like the CEO on a scale from 1 to 10? And that's subjective, but it's numerical, so it can be used for my valuation models. Then I do financial modeling, calculating what I think is the value automatically for more than 2,000 companies, with a lot of manual adjustments for 200 companies, and then investing in 60 companies. Then I conduct risk analysis, looking at how the portfolio in aggregate and variance of it and different companies can perform across many different scenarios. And then I have to have a portfolio where they in aggregate can perform well across many scenarios. And with all of those financial models, I can then make my decisions. Those decisions are either research decisions, so maybe I see a new risk materializing or a great opportunity for some investment, but I need to learn more about it. And so I have to research it. Then as I research it, maybe I realize I need to get some more numbers. So I get these numbers, they feed into my models. I make some changes to the model. This makes me see the world in a new light. And maybe there's something else I then realize I need to research. And then that goes around and around with me getting more data, different ways of modeling, doing more research. And then eventually those decisions and that loop has to spit out some investment decisions. So that can be that there's a company that I've already invested in, but I want to invest even more. Or maybe I want to have less of it. Maybe I want to add in a new company I didn't invest in before. The companies that are the most attractive investment opportunities that I have not yet invested in, they always have a potential to get in there. And the ones that are the least attractive ones that I've invested in there, always at risk of, getting dropped out of the portfolio. Then when we add up all those investment decisions over time, that becomes my portfolio. So today, my portfolio is invested in 60 different assets. The largest positions are in NVIDIA and TSMC, and you can always go in on eToro and see exactly what I have in my portfolio. Then if we look at my portfolio compared to the US economy, we can see that in the US, it's not just one industry where there is all the economic activity. It's spread across many different industries, and there's also great investment opportunities in many different industries. So in the US, property, professional service, and tech make up a larger part of the economy. In my portfolio, tech, energy, and finance make up a larger part. In terms of geographical allocation, I have slightly more invested in North America and Europe, and slightly less in Asia. And China is one where I have a lot less than many others. That was the initial presentation. Thank you very much for watching, and I'll now go through the many questions that I've received. So firstly, what do you think about Chinese auto companies, including BYD and NIO? So in general, I'm not very interested in the auto business these days. I think there are more and more competitors coming into this space, and there's already many competitors. Profit margins aren't that great, and they're only going to get worse, I think. So I'm just not interested in the auto business at all. I think it's not as bad as microwave oven business, but it's sort of getting there where not everybody can build a car, but many engineers certainly can, and many companies can. So it's just not that amazing of an industry. So you can become the big king in a not so attractive industry, actually. And then there are a lot of other issues with China that add risk to those investments. And that means that while you could consider some of them cheap on certain metrics, BYD a lot more than NIO certainly, it's still not one that I've wanted to have in the portfolio. How are you tackling the risk of deglobalization? So that's something that's been on my radar for a long time, and it's been, molded into the portfolio over the years, such that, for instance, when Donald Trump came with his tariffs, my portfolio was already quite well prepared, because I've for years been reviewing very carefully what the world would look like with less trade in the world and more sort of America go it on its own. And that's part of the reason I have more in America as well and less in China. But also, for instance, very specifically, more companies that can manufacture the right things in the right places and not have to ship them over the wrong borders that trigger tariffs. But tariffs is the start. There's other parts of it as well within the broader phenomenon of deglobalization and some of the large powers in the world potentially not really getting along that well. How are you adjusting your allocation between geographical regions? So I've slowly adjusted more over to the United States. I think that's been the biggest from there. And then the second part is I would probably have had a lot more money invested in Taiwan and China if it wasn't for threats that are very directly coming from the sources of risk that are also driving deglobalization. What is your view on Novo Nordisk? So I think this is an absolutely amazing company. It's also from my hometown in Denmark. I grew up in Bagsværd, just north of Copenhagen, and there's really only one big company there, and that's Novo Nordisk. I don't think it's really fairly priced in all the potential future breakthroughs that they can make. Unfortunately, they have made some mistakes in the recent past, and also their competitors are doing well, and there's sort of different angles of competition that are biting into their potentials to have higher profits and better prices over the next years. But overall, I think it's a really, really, really good company, and I think a great investment now. How do you see the role of commodities, including copper, uranium, and lithium? So in general, I'm not a big fan of commodities. Generally, with any commodity, I would prefer the company mining it compared to just holding the commodities. These three ones are very, very different. Copper, I really, really love, especially if it's copper in the right places. I think we're going to need a lot more copper, and I think there's some very hard supply constraints to how much copper we can get total from mining and recycling. That just makes it super attractive. Uranium is not really rare, so even though it's expensive and difficult to process, and we might not process enough of it for a near-term boom in nuclear power, it's ultimately plentiful. It's not like gold and copper where there's a limited supply. There's just so much uranium available. It used to be that miners were actually paying to get rid of it, and so it doesn't have that same characteristic. Price might spike for a few years if processing capacity doesn't keep up with addition to nuclear power plants. If that doesn't keep, but ultimately that's gonna the processing is gonna grow to match that, and then you don't get any excess profits. And it's a little bit the same story with lithium, that lithium is plentiful. It's not rare at all. There's so we don't have this sort of like ultimate supply limit where we are in the same way like ultimately with gold, where there's just so little of it that just makes it rare. But for lithium, it's expensive to process, expensive to make it into a lithium battery ultimately. But actually mining lithium, it's just plenty of places you can do that in an economically attractive way, that it's not really a great commodity investment from my perspective. I did invest very early on in lithium in Albemarle. That did very well. That was back when I invested in Tesla, and I thought, okay, actually they're gonna need a lot of lithium. And back then it was a little bit of a different characteristic. But yeah, then as I sort of developed this thesis that actually lithium is gonna be totally abundant, not have much excess profits, then I didn't like it anymore. What is your AI strategy? So AI is very, very important to my portfolio. You could almost say that my portfolio is based off of AI, and then everything else is just sort of to either complement AI or it's to safeguard against AI being developed more slowly. So I think AI is on a curve of that shape, which means that now some of the AI tools that we have seen are like having an 11-year-old assistant. That's not very useful. But suddenly they're like a 13-year-old assistant. And maybe now it's like having a 15-year-old assistant. And that's quite good. But I think there's a good case to be made that we're not really slowing down the progress of development, because we've seen that for many iterations now. So we have something called the scaling laws that are a little bit our AI equivalent of the old Moore's law. And when we are training a new model based off of the amount of compute we are using and the data we're putting in and how we're building it, can start to predict how good it's going to get, and then it actually sort of lives up to that. And you can do that quite far out and potentially expect that that's going to continue. And then with that, we will get to have very powerful models at some point. And then there's sort of a case where when AI isn't good enough, no one's using it for anything super important or meaningful. And then nobody's using it for anything super important and meaningful. And then so forth. But then suddenly when it's good enough, boom, then it becomes a very powerful tool. And that's the same thing when, nobody wants to have a touch screen on their phone when it sucks. Still don't want it. But then suddenly we have it when it's good. Suddenly, now everybody wants to have it. And then it's very fast. So it goes from like, nobody wants to pay $100 to receive $99. Nobody wants to pay $100 to receive $99.5. But suddenly, if you can receive $101 for paying $100, boom, then everybody wants it. So that's sort of the basis for it. And I think there are some companies that can make extraordinary profits from this. Is it best to copy with all at once or spread out investments over time? So if you have, it depends on the individual investor situation, basically. If you have a very large amount of cash sitting around earning a low interest rate that you don't need for at least 5 years, then probably a large part of that would be better placed in stocks in that time period. And so you'd be better off putting a lot of it into stocks immediately rather than sort of waiting and losing out on the average higher return from stocks compared to cash for that time period. If you're, receiving salary every month and every month you have a bit of extra money, or maybe every 3 or 4 months you have some extra money, then you can invest that slowly over time and then take advantage of, the sort of spreading the risk out over time. So those are sort of the two extreme different situations for where you want to do it all at once or continuously. Hypothetically, on average, it's better to be invested in stocks than cash in terms of average return. So if you are, adding in the cash constantly, then that might be optimal from a return perspective, but you might also spend too much manual time on it. So for many people, it makes sense to say like, it's once per month or once per year. You set like a cyclical schedule like that, so you can also sort of manage it within your own calendar and sanity. What do you think of Paul Atkins' speech about crypto regulation? So I thought it was a good speech. I think in general, it's an extreme change having the current Securities and Exchange Commission being pro-crypto from the old one that was against crypto. And that's part of Donald Trump's strategy of being quite pro-crypto. And that was sort of outlined when he spoke at the Bitcoin forum in July before the election. And that's sort of what we are now seeing the implications of. What is your view on quantum computing stocks? So I reviewed all of them, and after that, I found them very uninteresting. I don't think any of them have any potential for delivering anything good for shareholders for many, many years, and maybe never. Some will probably run out of money. Maybe some will be bought. Maybe some will just never do anything. So it's not something that I would want to invest in. We do have a little bit of indirect investment though, because actually Google or Alphabet is a leading lab for quantum computing. They've made some important breakthroughs, but again, it's nothing that can be sort of used for anything actually significantly useful. So it's not not very relevant. I think it's something where people are like, I don't know, people that missed AI or still haven't gotten around with AI, they were saying, I forget about AI, let's go on to the next thing. And then they want to jump ahead to and hope that quantum is the next thing. So, maybe they missed AI, maybe they missed blockchain, but maybe they can now catch it on quantum. And I think, that's the same mistake that many did years ago when I was still holding Meta, and people like, Meta, that's over now. No, we should switch over to Snapchat and to some of these new startups that are doing these things. And ultimately, they just did not perform as well as Meta just continued to do. So I think here, I really think AI is on the cusp of delivering great things, and I don't think quantum computing is. What is your opinion of European defense stocks? So I like these a lot. There are a lot of money that's going to be spent on European defense products. There are amazing companies that can deliver those products, and there is it's not fully priced in at all. And there is a bias in Europe towards buying more European, and all those forces sort of come together. And then from a risk management perspective, one of the biggest risks is a big war. And so having the right defense companies in such a case is a way to protect you, because a war can cause your assets over here to be destroyed. You're losing things over here, but then maybe you are making it back on the defense side. So I think it can be a way to protect your portfolio as well. What is your view of the Buffett indicator? So it's an okay indicator, but it's sort of every indicator has to be sort of put into a context here, where there's some issues with the Buffett indicator, in that when you're looking at the market cap of stocks only, you're not looking at all the private companies in the economy at all. So if you have a lot of non-listed companies, the more you have like that, and the more difference there's between the private companies and the public companies, the more skewed your number is going to be. And then with GDP, when you're just using this metric consistently, you're not really taking into account that there can be different outlooks for the future, which is not incorporated into GDP, but would be incorporated into prices. And then you might think that, oh, now the market cap is higher compared to GDP, but it's actually because there's great growth expectations for companies to deliver more profits in the future. So it's not a negative at all. I think that's the case right now. So yeah, it's not those are numbers you should consider amongst many other numbers to get a decent picture of how an economy is performing. Is there more room for Nvidia to grow? I think yes. They are going to grow a lot, and they are also going to expand their profitability. And I think they are just sort of getting further and further away from the competition. And then there is this tendency for many to think that just because a company has gotten big, it cannot get much bigger. But that's really not been the case historically. The Standard Oil became the world's biggest oil company, and their successor companies actually continue to be very good investments for like 100 years. You have when one of Warren Buffett's greatest achievements was that 9 years ago he bought a big stake in Apple, and at that time Apple was the biggest company in the world. And what happened? They became 10 times bigger. So that was like he bought into the biggest company in the world, and they became 10 times bigger. Sometimes the big one can become a lot bigger, and I think that'll be the case for Nvidia. What do you think of capital protection using models by Franklin Templeton? So this is an thing you can invest in on eToro, where part of the money is put in stocks and part of it's put in bonds, and then the percentage changes over time. But ultimately, having a part of your portfolio in bonds also has that means that you are on average, in my expectation, earning a lower return. Basically, when you're using leverage, you're borrowing money to invest. But when you're putting a part of your portfolio into bonds, you're doing the opposite of leverage. You're basically lowering your returns to then get that lower bond by getting a lower bond return, but also reducing your risk proportionally. Now, this also comes with the capital protection, so that they say that even if the stocks decline a lot, then they will cut you off at 0% nominally, but that still leaves the inflation risk. So overall, I think potentially for some investors, this is exactly the right product, but it's not something that I would want to invest in. Would you invest in Anduril if they IPO in 2026? So I think it's a great company, but it's also trading in private markets at a very high price. So I would have to see the prospectus, which when you do an IPO before this, they write a very big document with a lot of details about the company. So I had to read through this very carefully to see if there's any new details about the company, and then compare that with the price of the company. And potentially, I expect the price would be much higher than I would be willing to pay. So then I would not be investing. But potential things will be different. So it'll always be interesting to see. What is the impact of Trump's executive order to let retirement plans invest in private equity? So I think that's very fine, and it's in general a good thing. It has some risks, of course, but there are other risks that are more problematic for many retirement plans, in my opinion. In that, for instance, ones that you see many old people that have invested all of their money in bonds pretty much, which means that their entire portfolio is extremely subject to inflation risk. If suddenly money lose a lot of value, at the worst case, hyperinflation as they had in Germany between the wars, then those bonds could all be wiped out. And then your very, very safe portfolio that the government specified should be very safe turns out to have not been safe at all. And so for many of those portfolios that do need to add in some more stuff, and adding in private equity is a way to diversify in that way. But that said, I think there are a lot of the private equity funds that are really, really bad investments. When I look through what they own, it's just not great at all, and not compared to the prices that they cost. And so if that's what they're mostly going to be investing in, they're just, now they're allowed to make some bad investments, so they can go and make these bad investments, and that's not really helpful. But I think it should be allowed, and then people should be smart about the money they allocate to private equity. Did you sell all your Nintendo shares? So yes. So I bought Nintendo a long time ago. I made in total, I think it was 77% on Nintendo. So good return. I was very happy to see them releasing the cinematic universe, the Switch 2, now I think they're still a great company. There are other investment opportunities that are even better that I then prefer to have instead of Nintendo. What is your outlook for tech stocks? Probably the most extreme industry in terms of there being some companies that I just think are not going to make it, that they are just going to get out competed by others, or what they're doing is going to get commoditized and they won't get any excess profits. They're companies that have never been profitable, and I don't think they ever will be. So those I hate, but there are others that are the most interesting investments overall. So then when you average those out, you get to a number, you can say, okay, tech is good, but that's not like, it's not my goal to just have everything like that. Like, I don't want to have that, and I want to have this, and then based off of that, I think there's a reason to have a lot of tech, but you want to have the right tech. What is your outlook for commodities, including gold and oil? So I like gold mining, and I don't particularly like oil. I think with more electrical vehicles, fundamentally, that's a really hard hit for the long-term price of oil. And I think oil companies are also generally, it's for many people, when they invest in oil, they don't really take into account how much oil that company actually has access to. So you can have someone that looks very good on some metrics, but actually when you account for the fact that they're going to run out of oil, then it's like, right, they have to make that money back for you much quicker in that time while they have oil, right? Because then they're out of oil, then they can get some extra concessions and whatnot. But sort of, yeah, in terms of valuations, I don't like them too much. And in terms of gold, it's a great asset it can be used to protect your portfolio, but I think you can do better long term with gold mines. So that's what I put in the portfolio. What is your approach to risk management in the current market? So I diversify across many different industries, different geographies, and different business models. In the current market, we have to take account for more potential surprises coming from Trump, more geopolitical uncertainty, and there are specific risks where I said, okay, these, I have to keep a constant eye on and adjust my percentage for how likely I think they are to happen. And that all goes into the valuation of companies. So if you have a company that's, worth this much, but there's this, if this thing happens, they're really screwed. Well, then you have to adjust the value of coming down for that thing, right? So if you take an extreme example like TSMC, great company, can probably make a lot of money off of AI, but what if China suddenly blockades Taiwan? Devastating move. So then you have to adjust your valuation of the company based off of that. And it doesn't help to say like, that either I ignore it or I, get so scared by that I don't. You have to assess the probabilities and the impact, and then you can use that to correctly value companies based off of the, you don't have infinite information. If you knew the position of every photon in the universe, maybe you could make the perfect valuation. But, to the extent possible, you find the most things that are the most important and assign percentages to them. And then that sort of, can give you some idea of what you would want to be willing to pay for a company. When is it best to copy or add more funds? So in general, if you have too much cash and you want to be having more stocks, then it's a good time to get that money allocated in, because ultimately, on average, the stock market has delivered and probably will deliver higher returns than having cash. So the longer you wait, on average, the more you lose out. That doesn't mean that that this month is definitely going to go up or this month is definitely going to go down. That's sort of up to a lot of factors. But if you keep your money in cash for many, many, many years, probably you'll end up with a lot less than if you keep it in stocks. If you if you invested everything right before the great financial crisis in 08, then you would have, initially lost 50% of your investment. But today, that same investment would have overall more than tripled in value. So sort of like, even if you had invested at the worst possible time in that time period, you would still have done extremely well. And so that's sort of the way the most money has ever been lost has been by people waiting for stocks or property to come down in price, because inflation keeps pushing it up, and then growth profitability keeps pushing it up. So you're really sort of fighting against the waves go up and down, but you can't really fight the sea. What is your view on the CVR Playa US merger asset? So when Hyatt, they acquired Playa, then we lost our Playa shares, of course, but we received the payment from Hyatt in exchange, and I made a very good return on that. I forgot exactly how much that was, some 40-50% or something like that. So pretty good. And then as part of the acquisition, there was an agreement to create this instrument called the Contingent Value Rights Playa US merger. And that was so after Hyatt had acquired Playa, there would be a little period of time to see that things were in order. And if so, then an amount would be given to the owners of this instrument minus the value of things not in order. And then after that period, we then received some money for that amount, a very small amount, but that was fine. And then after that, you can then say, okay, now this sort of process has been completed, and we've locked in our great return from this investment. Now, I would have loved to keep Playa. I thought it was great, and it got acquired at a good price. But I think if it hadn't, we could have made even more money. So yeah, that's in a way unfortunate. So thank you very much for listening to or watching my presentation. And if you have any more questions or comments, you can always write them underneath any of my posts on eToro. Write me directly on Twitter or on LinkedIn. And yeah, thank you very much. And let's have a great quarter.